What is risk appetite? Why do some companies take bold, aggressive decisions, while others move cautiously? Why does one bank expand rapidly into risky segments, while another focuses only on safe borrowers? The difference often lies in something called risk appetite. Every organization must decide how much risk it is willing to take in pursuit of growth. Too little risk means missed opportunities. Too much risk means instability. Risk appetite defines that balance. It answers a very powerful question. How much uncertainty are we comfortable accepting? Let us understand this concept in simple and practical terms. Risk appetite is the amount and type of risk an organization is willing to take in order to achieve its objectives. It is not about eliminating risk. It is about defining boundaries. For example, a company may say, "We are willing to accept moderate market risk, but very low compliance risk." Or, "We are comfortable with higher growth volatility, but we will not compromise capital stability." Risk appetite provides direction to decision-making. Without it, decisions become inconsistent. With it, managers know the limits within which they can operate. Risk appetite transforms abstract uncertainty into measurable thresholds. Let us use a simple analogy. Two individuals have the same amount of savings. One invests heavily in equities, accepting volatility for higher returns. The other prefers stable instruments with lower returns but lower risk. Both are correct based on their risk appetite. The same logic applies to organizations. A startup may have high risk appetite because it seeks rapid expansion. A mature bank may have lower risk appetite because it prioritizes stability. Risk appetite reflects culture, capital strength, regulatory environment, and leadership philosophy. It is not universal. It is strategic. In structured organizations, risk appetite is formally defined. Boards set limits on credit exposure, liquidity gaps, concentration risk, and capital adequacy. For example, a bank may define maximum exposure to one borrower group, or set limits on loan-to-deposit ratios, or define acceptable volatility in earnings. These limits guide operational teams. If a proposed decision exceeds the defined threshold, it requires higher approval. Risk appetite therefore connects strategy with governance. It ensures growth decisions align with risk capacity. Without defined appetite, expansion can become uncontrolled. With defined appetite, growth remains disciplined. Why is risk appetite so important? Because most failures are not caused by external shocks alone. They occur when organizations take risks beyond their capacity. Rapid lending without capital buffers. Aggressive expansion without operational strength. High leverage without liquidity planning. These decisions often ignore risk appetite discipline. When market conditions change, vulnerability becomes visible. Risk appetite acts as a safety boundary. It prevents overexposure. It protects long-term sustainability. It ensures ambition is balanced with resilience. In regulated industries like banking and finance, risk appetite is closely linked to capital planning and regulatory compliance. Here is the key insight. Risk appetite is not about being conservative. It is about being intentional. Every organization takes risk, but successful organizations define in advance how much risk they are willing to take and in which areas. They communicate those limits clearly. They monitor them consistently. They enforce them strictly. Risk appetite transforms decision-making from impulsive to structured. It aligns ambition with capacity. And ultimately, it protects stability while enabling growth. In business, uncertainty is unavoidable, but uncontrolled risk is optional. Risk appetite ensures that uncertainty is managed within intelligent boundaries. And that is what separates sustainable organizations from fragile ones.